Have you ever looked at the volatile world of crypto and thought, how can I profit from these massive price swings, even when the market is going down? If you've been wondering how to amplify your trading power and potentially secure gains in both rising and falling markets, then you're in the right place. Today, we're diving deep into the powerful world of Kraken futures, a sophisticated platform that allows you to do just that. Kraken, a long-standing and highly reputable cryptocurrency exchange, offers a derivatives platform called Kraken Futures. This isn't your everyday spot trading where you simply buy and sell an asset. Futures trading, especially perpetual futures, opens up a whole new realm of possibilities, allowing you to speculate on the future price of a cryptocurrency without actually owning the underlying asset. It's about entering into a contract to buy or sell an asset at a predetermined price on a future date, or in the case of perpetuals, with no expiry date. This means you can go long if you believe the price will increase, or go short if you anticipate a decrease, profiting from both upward and downward price movements. The beauty of Kraken futures lies in its capital efficiency and flexibility. With access to over 95 perpetual futures contracts denominated in USD, you have a wide array of options to choose from. But what truly sets it apart is the ability to use leverage, amplifying your buying or selling power significantly. We're talking up to 50x leverage on some contracts, meaning a small amount of capital can control a much larger position. This, of course, comes with amplified potential for both profits and losses, making risk management absolutely paramount. Before we jump into the nitty-gritty of how to trade on Kraken futures, it's crucial to understand who can actually access this platform. Kraken futures isn't available everywhere. For instance, clients in the United States, Australia, Canada, the UK, and several other regions are currently restricted. It's always best to check Kraken's official support documentation for the most up-to-date list of geographic restrictions and verification requirements. Generally, personal clients need to be at least intermediate or pro-verified on Kraken to access derivatives trading. So, you've checked your eligibility, and you're ready to explore. The first step, naturally, is to have a Kraken account. If you don't already have one, signing up and getting verified to the appropriate level is your starting point. Once your main Kraken account is set up and verified, you'll need to transfer funds to your Kraken Futures wallet. This is a separate wallet specifically for derivatives trading. The process is seamless and typically takes less than 10 seconds, and best of all, transfers between your spot wallet and your futures wallet are free. You can fund your futures wallet with a variety of collateral options, including fiat currencies, stablecoins, and even other cryptocurrencies. The multi-collateral futures wallet is a fantastic feature, allowing you to use different assets as collateral to manage your positions without constantly moving funds around. For example, you could open a Bitcoin futures position, use USDT as collateral, and even choose to convert any profits directly into Bitcoin. Now that your account is funded, let's talk about the core of futures trading, perpetual contracts. Unlike traditional futures contracts that have a fixed expiry date, perpetual futures on Kraken futures don't expire. This means you can hold your position indefinitely, as long as you meet the margin requirements. This offers incredible flexibility, allowing you to focus on market movements rather than constantly rolling over contracts. The primary way you'll interact with the market on Kraken futures is through order types. Understanding these is fundamental to effective trading. First, we have market orders. These execute immediately at the best available market price. They are great for quick entry or exit, but be mindful of slippage, especially in volatile markets or with large orders. Kraken implements a protection mechanism to prevent market orders from executing at a price more than 1% away from the best bid or ask, canceling any unfilled portions. Next are limit orders. These allow you to set a specific price at which you want your order to be filled, or a better price. If your desired price isn't immediately available, your order will sit in the order book until it can be matched. Limit orders are crucial for controlling your entry and exit points and can help you avoid unfavorable slippage. It's important to note that limit prices must be within 20% of the mark price if crossing the spread. Then there are stop-loss market orders. These are vital for risk management. A stop-loss market order allows you to limit your potential losses on an open position. You set a trigger price, and if the market price reaches that trigger, a market order is automatically placed to close your position. This helps prevent catastrophic losses if the market moves against you. While you don't need margin to place a stop-loss market order, a margin check will occur when the order triggers, and if insufficient margin is present, the order will be rejected. Beyond these basic order types, Kraken Futures also offers more advanced options for sophisticated trading strategies. Always familiarize yourself with all available order types and how they function to best suit your trading style and risk appetite. Speaking of risk, let's dive into leverage and margin. This is where futures trading gets exciting, and also where it gets dangerous if not handled with care. Leverage allows you to control a position much larger than your initial capital. For example, with 10x leverage, a $100 investment can control a $1,000 position. This magnifies both potential profits and potential losses. Kraken Futures utilizes a sophisticated instant margining system, IMS, with two key margin parameters, initial margin, IM, and maintenance margin, MM. Initial margin is the amount of collateral required to open a new position. Think of it as a down payment. If your account's collateral value drops below the initial margin, any open orders that would increase your risk are immediately canceled, and you'll need to deposit more funds or close positions to open new ones. With that said, thanks for watching, and until next time.